Coming up on Business Incorporated today, World Bank sets ambitious targets for green and resilient economic growth in Africa. IMF says sub-Saharan economy needs billions of dollars and reforms to recover. Plus, Kenya's budget deficit likely to increase this year due to revenue shortfalls. We're glad to have you on the program. Thank you for joining us. I'm Bisi Adebayo. Well, let's begin the show with intraday market numbers in Africa, which were mostly negative. The indexes in Nigeria and South Africa were marginally lower by 0.08% and 0.05% each. Only the EGX30 in Egypt was positive by 0.49%. Kenya closed positive on Tuesday. But then it's a different picture entirely in the Middle East, where major markets are in the green zone except the Abu Dhabi index, which declined marginally by 0.08%. Dubai's main index rose 0.35% also at intraday. And elsewhere in the region, the Qatari index surged the most by 0.49%, while Saudi Arabia's index was marginally higher by 0.05%. Well, let's turn to Europe, where stocks were mostly higher today as investors await the outcome of a two-day meeting of the U.S. Fed Reserve's Federal Open Market Committee. Chelsea Delany is standing by at the Frankfurt Stock Exchange to tell us more about how this is driving market sentiment. Good afternoon, Chelsea. Well, the Federal Reserve will release its latest policy decision later today as the central bank works to combat a historic recession. What are investors expecting? All right, we'll get to Chelsea in just a moment. But for now, let's turn to Asia, where stocks were mixed today as investors also await the Fed Open Market Committee's quarterly update. In Japan, the Nikkei 225 closed fractionally higher at 23,475.53, while the Topix index advanced 0.21%. Mainland Chinese stocks, on the other hand, saw losses by the afternoon. The Shanghai Composite declined 0.36%. The Shenzhen component shed 1.006%. And Hong Kong's Hang Seng Index was a little changed as at its final hour of trading. Well, let's get back to Chelsea now, who's at the Frankfurt Stock Exchange to tell us what's driving the markets in the European scene this afternoon. Chelsea, earlier on I was asking that the Federal Reserve will release its latest policy decision later today, and that is as the central bank is working to combat a historic recession. What are investors expecting from this?
Investors are not expecting a ton of new information out of this meeting. If you remember the last time the Fed met, they really overhauled their entire inflation targeting framework. So it was really a very big and shocking moment for markets, and we saw a lot of after effects of that rippling across the world, and the depreciation of the dollar, the appreciation of all these other currencies. Stocks around the world were really boosted by this change in Fed policy. So after that big move, now investors are really looking at the Fed to see how they're now looking at growth prospects. The Fed has basically said that they do expect to keep interest rates low for the next couple of years, at least through the end of next year, but likely through the end of the following year. So investors are going to be looking for any indication of how long exactly interest rates in the U.S. could stay basically at zero. But they also will be looking for any changes in growth forecasts from the Federal Reserve. Growth in the U.S. has been doing a little bit better than most economists had forecast, so they could potentially raise their outlook for this year or next year as well. So that's also going to be a big focus for investors. But really, just any updates on how the Fed is looking at the recovery in the U.S., which is obviously important for the entire global economy, as well as the updates on forecasts for interest rates going forward.
One other issue investors are interested in is the fact that European Commission President Ursula von der Leyen delivered her first State of the Union speech today, and she laid out ambitious new climate goals for the bloc. What does she want to achieve?
So the new plan is basically to accelerate and be much more aggressive in plans to cut emissions across the EU. So the EU has right now a target of reducing emissions by 2030 by about 40%. They want to raise that now to 55%. So to cut emissions by an additional 15% over the next decade. That's quite aggressive. But what we heard from Chair von der Leyen today is that this crisis has really underscored just how much there is to do and how much more the EU needs to be doing to reduce emissions. So she discussed many other ways that the EU could close this gap, including renovating buildings to make them more efficient. And of course, here the transport sector is always a big topic of discussions. In Germany, there are a lot of automakers. France, Italy all have a very large economy based on transportation and vehicles. So that's also an area that needs to be addressed, and for there to be more efforts to reduce emissions, there obviously is going to have to be a lot more investment. So she also wants to see about 30 to 40% of the rescue package in the wake of the coronavirus being spent on climate-friendly investments. So really a very aggressive climate stance here, which is backdropped by a lot of concerns rising over climate change, including these massive wildfires in the United States right now, which she also mentioned today.
Now let's talk about Facebook, which could face an antitrust lawsuit in the U.S. before the end of the year. And that, of course, is according to media reports. Now, what will that mean for the social media giant?
If the U.S. regulators do follow through on this, it would be a very big problem for Facebook. Facebook has faced a lot of political criticism, a lot of regulatory scrutiny in the United States over a variety of issues, everything from their involvement in election meddling and privacy concerns, things like that. But an antitrust lawsuit would be a much bigger issue for them. It could potentially mean things like having to unwind certain acquisitions that they've made. What the regulators in the U.S. seem to be looking at now is some of the acquisitions they have made over the past couple of years, things like Instagram or WhatsApp, and whether those purchases, whether those deals were in some way anti-competitive. So Facebook could be looking at some potentially wide-scale challenges and changes to their business if the FTC, if the U.S. regulators do follow through on this. But it's also, because it is such a novel approach for U.S. regulators, this isn't really a case that they've brought before, bringing a tech giant under antitrust law. So it would take several years for this case to come to fruition. So right now, it's certainly a concern, but it's unclear how it's going to develop.
Well, we'll see how it develops in the coming days. Thank you, Chelsea. We'll see you again tomorrow. Well, let's see what headlines are currently driving the markets in the UK, and Juliana Olayinka will be telling us. Good afternoon, Juliana. Well, I'll start with this one, which might come as some good news for holidaymakers, as Thomas Cook has been relaunched exactly a year after the company ceased trading, leaving 150,000 holidaymakers stranded abroad. Will Thomas Cook be able to weather the storm as the travel industry faces the worst tourism crisis since records began?
In short, no, I don't think any airline will be able to weather the storm, or holiday maker company. We actually just heard from Alex Cruz, the CEO of British Airways, saying that they're in economic trouble. But, you know, 2020 is full of surprises, and this is certainly one. Thomas Cook re-emerging as an online-only holiday site. Fosun, the Chinese conglomerate, they were the major shareholder for Thomas Cook before they collapsed collapsed, and they actually bought the intellectual property rights for £11 million. And they have come up, as you said, a year after stranding 150,000 people abroad and losing thousands of jobs. As a new holiday-making company, they are hoping that they can fly people to destinations that have holiday corridors with the UK, including Spain, Italy and France, although, of course, you would have to self-isolate on your return. And I suppose it is seen as some good news for those who still hold Thomas Cook dear to their hearts, especially as it was over a 100-year-old company. But it's interesting you mention the pandemic. There have been eyebrows raised about the timing, considering the summer is practically over and we're not expecting a peak in demand over the next couple of months. But, you know, the name and the legacy still does survive. So it will be interesting to see if Fosun and Thomas Cook get the thumbs up from the Civil Aviation Authority, are due to make an announcement about whether or not they can do business later on this week.
I guess we'll keep our fingers crossed then. And now, the Organization for Economic Cooperation and Development is warning government to resist imposing spending cuts and hefty tax rises before their economies recover from the effects of coronavirus lockdowns. What are the OECD's reasons?
Really, the OECD, they are a think tank. They're a Paris-based think tank, and they typically give advice to the wealthiest of nations in the world. And they actually have revised their outlook. I believe back in June, they said they expected the global downturn to be at about 6%, but now they've said it's likely to be about 4.5%, as we are seeing, particularly in Asia, the bounce back is happening faster than expected. But for most nations, they expect the recovery to last for quite some time. In some nations, they don't expect them to be seeing growth at pre-crisis levels until the end of 2021. So to sustain economies, the OECD have suggested that public spending isn't reined back. Here in the UK, a lot of people have used that to point fingers at the Chancellor, Rishi Sunak. We know, because we've discussed this extensively, Bissy, that there are growing calls from the Labour opposition party and unions. The TUC have been doing their union meeting this week, saying that the furlough scheme shouldn't come to an end at the end of October. We had unemployment data out yesterday showing that unemployment had risen to 4.1% in this country, still pretty low if you compare it historically and internationally, but we are looking back in the rearview mirror. We're not expecting to see that tsunami until the end of next month. So there are suggestions that perhaps the furlough scheme could be extended to particular sectors and should be phased out, like we're seeing in Germany and France. So the information from OECD today and the call for governments to not rein in on public spending should perhaps jolt Chancellor Rishi Sunak to change his plans.
All right. Now, this morning you spoke with Chimi about the latest inflation numbers, but how are the markets reacting to that data at the moment?
Well, the FTSE All-Share is in a kind of wait-and-see mode at the moment. I heard you speaking in Frankfurt about the US Federal Reserve. We're not expecting any changes, but again, everybody's waiting and seeing. The All-Share is down 0.01%. The FTSE 100 is up by 0.01%, and the FTSE 250 is down by 0.15%. On the currencies market, the British pound is up on the US dollar by 0.47%, up on the euro by 0.33%, and up on the Japanese yen by 0.11%. We did have inflation data this morning released by the Office for National Statistics, showing that inflation has fallen to a 5-year low at 0.2%. Lots of suggestions, of course, are down to August's Eat Out to Help Out scheme, where the government were offering a 50% discount up to £10 on meals between Mondays to Wednesdays. Over 100 million meals were used in that scheme, and that's really where the downturn has come from, Bissy.
All right, Juliana, thank you. We'll see you again tomorrow. And U.S. stock futures were little change in early morning trading today as investors readied for comments from the Federal Reserve later in the day. Dow futures were up 25 points and S&P 500 and Nasdaq 100 futures were also slightly higher. The domestic commodities market update will be up next when we return in just a moment. Be still with us. Welcome back. The World Bank has released the Next Generation Africa Climate Business Plan, which sets out a blueprint to help sub-Saharan African economies achieve low-carbon and climate-resilient outcomes. The plan calls for countries to seize the opportunities to scale up climate resilience to grow their economies and reduce poverty and take advantage of sustainable and innovative approaches to leapfrog into greener development pathways. As the largest financier of climate action in Africa, the World Bank will use this new climate plan to build on a strong track record under the original plan, in which the bank supported 346 projects with more than $33 billion in the World Bank financing over the past 6 years. Kenya's finance minister says the country's budget deficit is likely to increase this year due to revenue shortfalls and coronavirus-related disruptions. The finance minister, who had set the deficit at 7.5% of GDP when he presented the budget in June, did not say how far the gap was likely to expand. Revenue collection underperformed by 40 billion shillings in the first 2 months of the financial year. Kenya is in early talk with the World Bank for the provision of an additional budgetary support loan. And the International Monetary Fund says that sub-Saharan Africa will need hundreds of billions of dollars and reforms for a resilient recovery from the impact of the coronavirus pandemic. According to the IMF Managing Director, Kristalina Georgieva, and Abebe Selassie, the Multilateral Lenders Director of Africa Department, support from the international community covering stepped-up debt relief, financing and capacity development will be needed for the continent. Georgieva states that the IMF has approved more than $15 billion in financial assistance and debt service relief to sub-Saharan African countries in a bid to offset the impact of the pandemic, and will be doing more in the years ahead. The IMF, in its World Economic Outlook published in June, projected that the regional economy will contract by 3.2% this year before rebounding to grow by 3.4% in 2021. All right, it's time now for our domestic commodities market, and we'll be talking about onions, which is widely consumed in Nigeria and a major component of the food basket. Now, the domestic price of onions has jumped 200% to 30,000 naira per bag in the last 12 months, when food inflation year-on-year increased by 16% in August. Joining me now to talk more about the production and price movement of onions in Nigeria is Dumebi Iyeke, a research analyst at the Financial Derivatives Company. Good afternoon, Dumebi. Thanks for joining us on the program. Of course, seasonality is a major driver of price changes in tomatoes, pepper and onions. Could this be the reason for the sharp increase in the price of onions? And what do you think will happen to the price during and after harvest?
Thank you so much for having me, BC. First of all, onions is a widely consumed ingredient both in Nigeria and globally, and the use of onions varies across culinary, pharmaceuticals, and skincare, most recently skincare. Bringing this to the domestic market, seasonality is one major, driver of price swings in agricultural commodities, and one can say that 2020 has really stood out in terms of, price changes or sharp price increases in various agricultural commodities, including onions. Seasonality is not just the only factor that has caused this sharp price increase in onions, but we look at other factors like the lockdown, which, brought along with itself, supply chain disruptions. We're also looking at higher logistics costs, higher transport costs, so all of this put together are reasons why the price of onions has stayed high at this time in 2020. So looking at the harvest season, normally agricultural commodities are associated with two seasons, the planting season and the harvest season. During the planting season, prices are higher. Why? Because there is shortage in supply, and during the harvest season, prices are lower because now there is ample supply. So post-harvest, we're likely to see a decline in the price of onions, and this is because there is now ample supply of onions in the market.
Now, you say there's ample supply of onions in the market, but then it's rather interesting to know that although Nigeria is the second largest producer of onions in Africa after Egypt, the country still imports and smuggles over 1 million tons of onions. What's responsible for this, and what do you think can actually be done to boost domestic production in the near term?
I mean, the major factor responsible for this is that there is a demand gap in the market for onions. Domestic demand for onions is about 2.5 million tons. Meanwhile, local production is just about 1.4 million tons. And this shortfall in demand is now serviced through imports and smuggling. So that's why we're seeing that dynamics in the production of onions in Nigeria. And not only the demand gap, but we're also looking at the location for production of this commodity. The production of onions is predominantly in the northern region of the country, and these particular states have been battling insurgency and insecurity, and this has drastically affected the production levels of various agricultural commodities, of which onions is a part of. The farmers are not able to go to the farms as much as they used to before, so this has largely affected the production capacity of onions in Nigeria. Now, what can be done to boost production? The first thing is that all the factors, impeding the production of onions in Nigeria need to be addressed. And all these factors, range from poor storage facilities to price fluctuations to high cost of production and high transport costs. So if all of these factors are addressed, there would be some form of increase in the production of onions. And not only that, if we also, if the government is able to, put adequate investment in post-harvest management and practices. Why? Because storage losses, account for a reduction of over 20% of Nigeria's onions produce. So what am I trying to say? And what I'm trying to say is that after harvest, Nigeria loses about 20% of its onions produce due to inadequate storage facilities. So this simply calls for a higher investment in proper storage facilities, and storage facilities that not just would keep the onions, but keep them well enough to increase their shelf life. So these are some of the factors that can come into play to increase production. And in terms of the storage facilities, these storage facilities, details concerning the temperature, concerning the humidity regime, concerning irradiation, all need to be factored in to make sure that the storage structure and storage facilities are up to par to ensure that these onions don't, we don't lose a bulk of our produce due to inadequate storage facilities.
I'd like to thank you, research analyst at the FDC, Dumebi Iyeke, for sharing your thoughts with us on the program. Let's wind down with oil prices now. They actually rose for a second day today, gaining more than 2% as a hurricane closed U.S. offshore oil and gas production, and an industry report showed that U.S. crude inventories decreased. Brent crude rose 2.1% to $41.38 a barrel, while U.S. crude was up 2.4% to $39.20 a barrel. More than 25% of U.S. offshore oil and gas output was shut, and export ports were closed on Tuesday as Hurricane Sally sat just off the U.S. Gulf Coast. And that's where we end our show today. Thank you for watching. I am BC Adebayo.